Alphabet has just completed a financial milestone worthy of the history books. Its full-year revenue has officially surpassed $400 billion. At this massive scale, Q4 revenue still delivered an 18% acceleration in growth, completely defying expectations. But this isn't just a celebration of numbers. Behind this earnings report lies a bold $185 billion strategic gamble. Alphabet is attempting to fundamentally reshape the underlying logic of the internet through in-house chip development, AI agent protocols, and a future where 50% of its code is generated by AI. Hey everyone, welcome back to Deep Dive Stock Earnings. If old Google was the organizer of information, today it's trying to become the executor of tasks. We're breaking down not just its surging cloud margins, but how a $185 billion capital spending push is building a defensive wall to avoid becoming the next Yahoo. Alphabet's financial performance is showing an extraordinary kind of scale acceleration. Q4 revenue came in at $113.08 billion, with earnings per share beating expectations by 7% after crossing the massive $400 billion annual revenue mark. Google's growth engine hasn't slowed, it's actually getting stronger. From a financial standpoint, this signals that Google has successfully converted AI from a cost center into a real revenue driver, with its vast ecosystem generating deeper user stickiness and higher value per interaction. To still be accelerating at this scale tells you the moat is actually widening with AI. The market used to worry that a giant like Google couldn't move fast, but now that giant is moving like a cheetah. And this isn't low-quality growth driven by traffic inflation. This is high-quality growth powered by AI improving monetization efficiency across both ads and cloud. To avoid falling behind in the AI race, Alphabet has issued a staggering capital expenditure outlook, $175 to $185 billion. For 2026, this massive investment follows a precise 60-40 structure, 60% allocated to rapidly evolving servers and chips to stay competitive in compute, while 40% goes into long-term assets like data centers and power infrastructure. This isn't just expansion, it's a defensive investment strategy with a sense of urgency. Even inevitability, $185 billion is larger than the GDP of some countries. Google understands that in the AI era, compute capacity equals survival. Without this level of investment, it risks a Yahoo-style collapse. By locking capital into land, power, and data centers, Google is essentially laying the foundation for the next 20 years of internet infrastructure. Google Cloud has fully transformed from a loss-making segment into a core profit engine. Revenue grew 48% to $17.07 billion. But even more striking is the operating margin, jumping from 17.5% last year to 30.1%. This kind of leap confirms a structural upgrade in the business model. Google Cloud is no longer just a low-margin provider of storage and compute, it's becoming the go-to platform for enterprises deploying AI models and security solutions. A doubling in margins is the clearest sign that scale effects are kicking in. As AI model training and deployment become essential for enterprises, Google Cloud's full-stack AI solutions gain massive pricing power. This kind of margin expansion significantly strengthens Alphabet's overall earnings foundation. There were concerns that AI chatbots would cannibalize traditional search ads, but the data tells a completely different story. Search revenue still grew a solid 17%. More importantly, AI is fundamentally changing how users search. Query length has tripled compared to traditional searches. Instead of searching for weather, users are now asking things like plan a trip. These more complex queries carry stronger commercial intent, significantly increasing ad value and pricing power. This is the real dimensional shift AI brings to search. Users aren't just looking for information anymore, they're looking for solutions. And behind every deep query is a clear buying intent for advertisers. That's incredibly valuable. AI didn't kill search, it expanded it, creating more ad inventory and higher value clicks by extending the user journey. Alphabet also confirmed a major development. Apple is using Google Cloud infrastructure to train its own foundational AI models. This is one of the most significant validations in the AI infrastructure space. Even a company with nearly unlimited resources and full-stack integration capabilities has concluded that renting Google's infrastructure is more efficient than building its own. Apple's decision is essentially a gold stamp of approval for Google's AI capabilities. It shows that Google's GPU clusters and large-scale training efficiency have reached a level where even top-tier giants have to rely on it. This kind of validation creates a powerful signaling effect, likely attracting more enterprises that demand peak performance and efficiency. To reduce reliance on NVIDIA and lower operating costs, Google is aggressively scaling its in-house fourth-generation TPU chip, Ironwood. Today, key internal workloads including Gemini training, YouTube recommendations, and search are already running on these chips because their cost is significantly lower than external chips. This proprietary hardware stack is becoming a long-term margin protector for Alphabet. This is where the real competitive advantage lies in the AI era. Whoever lowers the cost per unit of compute wins both in pricing wars and in margins. By designing its own chips, Google achieves deep hardware-software integration. It can tailor chips to its own algorithms and eliminate the margin taken by external suppliers. Alphabet's strategic focus is shifting from providing answers to executing tasks to platforms like Google Anti-Gravity. The company is working to establish a universal commerce protocol. The ambition is to become the foundational browser layer of the AI agent era, where AI agents handle tasks like booking, shopping, and scheduling on your behalf, all running on Google-defined standards. This is ultimately a battle for protocol control. Google understands that future internet traffic may no longer come from human clicks, but from conversations between AI agents. By defining a universal commerce protocol, it's trying to rebuild the internet's foundation just like HTML or HTTP once did. Internally, Google is undergoing a radical efficiency transformation. Around 50% of its code is now generated by AI agents. Financially, this means expensive operating expenses like engineering, labor are being converted into capital expenditures on servers and compute. In essence, Google is buying chips to prepay for future digital labor, unlocking an entirely new level of operating leverage. To sum it all up, Alphabet has completed a powerful self-reinvention to its $185 billion investment and deep push into AI agents. So the question is, in a future dominated by AI agents and proprietary compute, has Google fully eliminated the risk of disruption? Let me know what you think in the comments. This is Deep Dive Stock Earnings, and I'll see you in the next one.